Welcome back to the deep dive. So I want you to just, close your eyes for a second. Picture this. It is 2026. You've finally decided to do it. You're spending weekends at open houses. You're scrolling listings at 2 in the morning. You're mentally placing your couch in that living room. It's the dreaming phase. It's electric, isn't it?
It's the best part. It's just pure possibility. You're, building a whole new life in your head.
Right. But then you find the one, you make an offer, and suddenly that dream just hits a brick wall.
Or a paper wall.
A paper wall, exactly. We're not talking about the house. We're talking about the documents you need to actually get the money to buy it.
The paperwork mountain. This is where the enthusiasm usually, well, it goes to die. It's the friction between, I want this house and I own this house.
It feels like a test of endurance, really. So our mission today is to flatten that mountain. We've gone through a ton of lender guidelines, federal rules, all of it, to build what we're calling the mortgage blueprint.
Yeah.
We want to take that chaotic list and turn it into a streamlined checklist.
And move you from scrambling for papers at midnight to being pre-approval ready.
Because in the 2026 market, speed is currency. If you're looking for an old tax slip while another buyer is submitting a clean digital folder, you can lose the house. It's really that simple.
It is.
To guide us, we're looking at a really interesting case study, the team at Muneris Financial Services. What's so interesting is they don't stay in their silos. They have the mortgage broker and the real estate broker all under one roof.
Which is, that's incredibly rare. Usually those two barely talk to each other unless something's gone wrong.
And leading that team is the CEO, Mansour. And his own background is as a life insurance broker. So you get this triad: find the house, fund the house, and then protect the house. And we should say, if you want that kind of guide, you can reach out to Mansour directly. His cell is 778-898-3202, or you can email him at mansour@muneris.com.
It's a great model. It just anticipates problems before they even happen.
So let's get into it. We've identified the big six. These are the 6 categories of documents every lender in Canada is going to demand in 2026. We're talking identity, income, down payment, assets, property details, and your professional contacts.
But before we even start checking boxes, we need to understand the why. Why are lenders so obsessive about all this paper? It's not just red tape.
It really feels like it is when you're in the middle of it. Like they just want to see if you kept a receipt from 3 years ago.
I know it feels that way, but they're operating under really strict federal rules. They need to verify you can survive the stress test.
We hear that term all the time, the stress test. Break that down for us. What are they actually testing?
They're testing your ability to pay if interest rates go up. So even if you get a great rate, you have to qualify as if your rate is either 5.25% or your contract rate plus 2%, whichever one's higher. And they do that by looking at 2 key ratios, GDS and TDS.
Okay, let's pause on the acronyms. GDS, what is that?
GDS is gross debt service. So think of it as the cost of the house itself against your income. It's your mortgage, property taxes, heating costs. If it's a condo, half your condo fees are in there too. Lenders usually cap this at 39% of your gross income.
Okay, so about 40 cents of every dollar I earn can go just to the house. What's TDS?
TDS is total debt service. So that's the house plus all your other debt.
Everything else.
Everything. Car loans, credit cards, student loans. The cap here is 44%. Every single document we're about to talk about is just evidence to prove you fit inside those 2 boxes.
That clears things up. They're not being nosy. They're just trying to solve that math problem. So let's start with the easiest one. Category 1, proof of identity.
This is the quick win. Lenders need a government-issued photo ID. A passport is sort of the gold standard. Driver's license works, or a permanent resident card.
Simple enough. Okay, now the heavy lifting. Category 2. Proof of employment and income. I feel like this is where most people get tripped up. They think, I have a job, I have income.
Right. But lenders call this verifying the steady stream. They need to know the money is consistent. And the documents change a lot depending on how you earn it.
Let's split it up. Salaried employees first. The 9-to-5 crowd.
For them, it's a 3-step check. First, a letter of employment. And listen, this can't be the offer letter you got 5 years ago.
So I can't just dig up that old welcome email from HR.
No, absolutely not. It needs to be fresh, like dated within 30 days. Has to be on company letterhead, and it has to state your position, your current salary or hourly rate, and how long you've been there.
Okay, so step 1 is the letter. What's 2?
The evidence. Your 2 most recent pay stubs. This just proves the numbers in the letter are actually hitting your bank account right now.
And step 3?
The history. You'll need your T4 slips for the last 2 years, but here's the one that always surprises people. The Notice of Assessment, or NOA, from the CRA. for the last 2 years.
Wait, why do they need the NOA if I already gave them the T4? The T4 shows what I made.
The T4 shows what you made, but the NOA shows what you owe. It's a concept called crown priority. If you owe the government money, the CRA's claim on your assets actually comes before the bank's mortgage.
Seriously, the government gets paid before the bank does?
Always. So the lender needs that notice of assessment to confirm your tax bill is zero. They need to know they're first in line if something goes wrong.
That's a huge insight. I never knew that. Okay, that's the salaried path. What about self-employed folks? I don't have a boss to write a letter. I don't get T4s.
For self-employed, it's a bit more of a treasure hunt. You need your full T1 general tax returns for the last 2 years, the whole package. And you still need those 2 years of NOAs to prove you don't owe taxes.
And that's it, just the tax forms.
Nope. You also have to prove the business is real, so a business license or your articles of incorporation. And critically, they often want to see cash flow. So be ready to show 6 to 12 months of business bank statements.
To see the money actually moving through the account.
Exactly. They want to make sure the business is liquid enough to support the income you're claiming.
Okay, we've proved who we are and what we earn. Now we need the cash to close. Category 3, down payment. This seems straightforward. Here's my bank balance.
You'd think so. But this is where anti-money laundering laws come in. In Canada, you can't just show up with a pile of cash and say, I have it. You have to prove the source.
So having the money in my savings account isn't good enough.
You have to show the path. Lenders need a 90-day history of the accounts holding that money. So your TFSA, your FHSA, your savings account, they're looking for any large, weird deposits.
What's considered large?
Anything that's not obviously payroll. If 10 grand just shows up out of nowhere, you have to explain where it came from.
Which leads to a really common situation. What if that money is from my parents, the bank of mom and dad?
Oh, very real. But a simple e-transfer won't cut it. You need a signed gift letter. It's a specific legal document where your parents state that the money is a gift, not a loan.
Why does that matter so much to the bank? Money is money, right?
Not to a lender, no. It goes back to those ratios. If it's a loan, it's a debt. That counts against your TDS ratio, that 44% cap. If it's a gift, it's equity. It totally changes your affordability picture.
That makes perfect sense. And in 2026, what are the common sources we're seeing?
Lenders are very used to seeing the FHSA now, the first home savings account. You put in 8 grand a year up to 40,000. And the RRSP homebuyers plan is now up to a $60,000 withdrawal. Just have those statements ready.
And if you're selling a place to buy a new one,
then you need the statement of adjustments from the sale. It proves the net proceeds you actually got after paying off the old mortgage and all the fees.
Okay, that's the cash. But they also want a picture of my whole financial life. Category 4, assets and debts.
This is your net worth snapshot. On the asset side, gather recent statements for investment stocks, GICs, that kind of thing. Even the value of your car helps paint a fuller picture.
And then the debt side. The part everyone tries to hide. We all have that one credit card balance we're not proud of.
And that's a huge mistake. You have to give them a full list. Car loans, student loans, everything.
But won't showing more debt just hurt me?
Hiding it hurts more. The lender's going to pull your credit report. If you didn't tell them about a $500 a month car lease and they find it, it looks like you were being dishonest.
Oh.
And it throws off all the math. It's much better to be upfront so your broker can calculate that TDS ratio correctly from the start.
Got it. Transparency saves time. Okay, let's pivot. We've covered the person, the money, now the target. Category 5, property details.
This is where that Minera's team structure really shines. In a typical deal, you, the buyer, you're the middleman. The realtor sends you a listing, you download it, you forward it to the broker.
Right. It's just email ping pong. Forward this PDF. Did you get that?
Exactly. But in a team like that, the real estate broker could just hand the documents directly to the mortgage side. It removes all that friction. But either way, you need the MLS listing, the full feature sheet.
And once you have a deal,
you need the accepted agreement of purchase and sale, the signed contract. That's the legal basis for the entire loan.
now there's a specific landmine for condo buyers here, right?
A massive one. The status certificate. If you are buying a condo, this document is absolutely non-negotiable. It's the financial health report for the entire building.
What are you looking for in there?
Does the building have enough money in its reserve fund to fix the roof next year? Are there any major lawsuits against the condo board? Lenders will just flat out refuse to finance a condo if the status certificate looks bad.
Good to know. Okay, finally, category 6, professional contacts.
This is just the admin wrap-up. The lender needs to know who to send the money to. So the name and address of your lawyer or notary and your real estate agent's office info.
And that brings us back to that synergy idea. Having a team that's already connected just solves so many communication problems.
It does. And I want to touch on that third piece of the Munoz model, Mansur's role as a life insurance broker. It sounds separate from getting a mortgage, but it's totally connected to keeping the home.
How so? I always think of insurance as, something to deal with way later.
Well, think about the risk. You just spent weeks proving you have the income to carry this huge debt.
Mm-hmm.
What happens if that income just stops because of illness or, something worse?
Right.
The bank protects its investment. You need to protect your family's ability to stay in that house. It's risk management for the dream you just fought so hard for.
So it's not an upsell. It's about securing the asset. Okay, we have our big six. Now for strategy. What is the #1 pro tip for 2026?
The digital folder. Do not wait for the broker to ask for these things one by one.
A preemptive strike.
Yes. Before you even book an appointment, scan everything. Label it clearly.
Right.
T42024.pdf. paystubjan15.pdf. If you can send your broker a single zip file with 90% of this stuff in the first email, you instantly jump to the front of the line.
It just signals you're a serious buyer.
And that organizational speed is a competitive advantage. It lets the broker focus on strategy, not chasing you for paper.
Now, we have to talk about the money that isn't the down payment. Clothing costs. This is where people get blindsided.
The surprise money. You need to budget between 1.5 and 4% of the purchase price for this, on top of your down payment.
That's a huge chunk of change. 4% on $1 million home is 40 grand. Where is it all going?
The biggest piece is usually land transfer tax. If you're in Ontario, BC, or Toronto, it's significant. But remember, the rebates for first-time buyers in places like Ontario, BC, PEI, and Toronto, they can knock thousands off that bill.
So checking that eligibility is key. What else?
Legal fees, title insurance, and adjustments.
Adjustments? What's that?
Things like prepaid property taxes. If the seller paid their taxes for the whole year and you move in June, you have to pay them back for the half of the year you'll be there.
That makes sense. And finally, the home inspection.
Right. It's not a bank document, but it's essential for your own peace of mind. Getting a certified pro in there to check the structure, the systems, look for leaks, you just can't afford to buy a lemon.
Okay, we have covered a lot of ground, from the dreaming phase to the stress test, the big six, and closing costs.
It's a lot, but having a checklist turns that mountain into a series of steps.
And remember, if it feels like too much, resources like Munoz Financial Services are designed for this. Again, you can reach Mansur at 778-898-3202 or online at muneris.com. That's muneris.com.
Having a guide just makes the whole climb manageable.
Before we sign off, I want to leave everyone with a final thought about this 2026 landscape. We've seen some pretty major rule changes lately.
Huge changes. The government now allows a 30-year amortization for first-time buyers on new builds. And the cap for insured mortgages went up from $1 million to $1.5 million.
That fundamentally shifts the definition of a starter home, doesn't it?
It really does. And it raises a question for everyone listening. With these new rules letting you stretch payments longer and buy more expensive property with less down, are you buying for today's needs? Or are you using these rules to skip the starter condo and jump straight into your forever home right out of the gate?
Are you buying for 2026 or for 2046? Something to think about while you're scanning those tax returns. Thanks for diving in with us.
Always a pleasure. Good luck with the paperwork.
See you next time on The Deep Dive.